This new ETF could destroy SCHD in the long term. SCHD, or Charles Schwab's US Dividend Equity ETF, is often regarded as the king of dividend ETFs, and for good reason. You invest in roughly 100 high-quality dividend-paying stocks from a broad range of sectors for the added benefit of diversification. An impressive starting dividend yield of around 3.5%, where your dividends actually can grow and compound every single year from SCHD's ability to generate more and more dividends, which means more money in your pockets that can fuel that retirement you've always dreamed of and more passive income. Of course, this ETF has a low expense ratio of just 0.06% and an excellent track record of performance despite being a dividend-focused fund of returns of over 11% annually over the last 5 and even 10 years. This is great and all, but as many of you know, SCHD actually experienced a bit of a slowdown as of recently, where it significantly lagged the market or the S&P 500 index such as VU by Vanguard over the last couple of years. The reason for this lack of performance and underperformance for SCHD is because SCHD does not have that much technology, where technology has been virtually the best place to be over the last decades and as of recently for the best and highest returns possible in the stock market. So where an ETF like VU has tripled the amount of technology exposure than SCHD, I could see why SCHD has lacked recent performance. The real question that you might be wondering is what ETF could destroy or be way better than SCHD in the long term. Logically, it should be an ETF that has more of an exposure to the tech sector. You might have guessed the covered call ETF JEPQ or JEPQ, a technology-focused covered call dividend ETF, but that's not the best comparison in my opinion, since JEPQ is a covered call ETF and SCHD isn't a covered call ETF. A common mistake I see investors make is comparing SCHD to a covered call ETF, a growth ETF, maybe even a broad market ETF, which is the worst comparison to make because they have different fund methodologies, the ETFs are completely different categories, and they are not a direct apples to apples comparison. But I found this one new ETF. Reason why I'm saying new is because this ETF isn't talked about that much, it's not as popular, it falls under the radar, and it's quite an underrated ETF, if you will. So this new ETF that could potentially blow SCHD out of the waters in the long term is DGRO, or iShares Core Dividend Growth ETF. DGRO offers diversified exposure to high-quality dividend-paying companies that have a history of sustained dividend growth, making it a strong long-term ETF choice for investors. DGRO's strategy focuses on diverse sector allocations, emphasizing that one sector really lacking in SCHD: technology. So DGRO has nearly double the tech sector allocation than SCHD, making it a bit of a better long-term capital appreciation choice while also having similar SCHD sectors that are financials, healthcare, consumer defensive, and industrials. I love how DGRO has those three main sectors of financials, technology, and even healthcare, which not only enhances long-term capital appreciation, but it also provides resilience in downward markets. DGRO has familiar and high-quality holdings that of 407 holdings, where its top sectors are JPMorgan Chase, Johnson & Johnson, AbbVie, Broadcom, ExxonMobil, and even Microsoft. Fun fact is that SCHD actually had Broadcom as one of its more notable holdings before they got rid of it on the chopping block in its more recent reconstitutions. And ever since SCHD got rid of Broadcom, Broadcom just exploded to the moon in returns, so SCHD investors really lucked out. But that's okay because DGRO has Broadcom, Apple, and even Microsoft, so it's able to mimic the movements of the S&P 500 index better than SCHD. Me personally, I actually prefer a lower starting dividend yield because these companies can reinvest their capital back into their businesses to grow their business and expand their revenues and net income versus paying out such a high dividend to investors. If a company reinvests more capital into their businesses and grows their revenues and net income, this could pay off way more in terms of capital appreciation to investors than a high dividend will in the short term and even the long term. DGRO has a low expense ratio as well of just 0.08% and a quite impressive track record of performance as well of over 10% annually over the last 5 years and over 11% annually over the last decade. Taking a look over the last 5 years, we see both SHD and DGRO sharing very similar returns, but over the last 3 years, we see DGRO flip and crush SHD because of technology absolutely booming, where DGRO beat SCHD. And over the last year, the same is true as well of DGRO's dominant performance over SCHD. So far in 2025, as of now, DGRO is still continuing this trend of outperformance and might continue this trend into the future and beyond if technology continues to outperform the market. And I don't see technology, innovation, or AI stopping anytime soon. So to sum it up, SHD is a great choice and a perfect ETF if you prefer a higher starting dividend yield and of course those high quality dividend value paying companies. DGRO is a great ETF if you prefer a lower starting dividend yield and more dividend growth into the future. Of course, if you want long-term capital appreciation, as well as those high-quality value and growth companies, because DGRO does have growth stocks because of more exposure to technology, which is considered a growth sector. Now, I invest in both SHD and DGRO, but it's a very small position in my whole entire ETF portfolio because I rather prefer to invest in both growth and broad market ETFs because of my risk tolerance, and of course, I am young and I have a long time horizon to invest. Why I invest in both of these ETFs is because if you combine SHD and DGRO, they can be a strong power duo of a high dividend yield, good capital appreciation, and exposure to virtually every sector of the market, and you won't complain about poor returns because you have DGRO to carry in terms of capital appreciation, SHD for those high dividend payments, and the best of both worlds. Taking a look, if we only invested in 100% only in SHD over a 10-year time period, we would have ended up with a 10.5% compounded annual returns versus if we had to say a 50% split to both SHD and DGRO, we would have ended up with slightly better returns overall of 12.8% over the same 10-year time frame. Only investing in SHD would provide around 10% exposure to the technology sector, while SHD plus DGRO combined together gives you over 14% exposure to technology, or 40% more than only having SHD, and you still have other sectors of the market for diversification as well. If we invested $100,000 back 10 years ago, we'd have nearly $300,000 now or more if we included DGRO with SCHD. If we shorten the time period over the last couple of years, we see a greater divergence of returns where only investing in SCHD provided just 8.7% returns annually, while that 50-50 split to both SHD and DGRO gave 11.7% returns or 3% more per year than only buying SCHD. The disparity becomes more apparent where if we invested $100,000 back only a couple of years ago, you'd end up with more of course with SHD plus DGRO as that power duo. All in all, both of these ETFs serve very similar purposes of dividends, passive income, and of course fueling that retirement dream of yours and any of your retirement goals. Whether you go all in on SHD, all in on DGRO, or a combination of both these ETFs, or many other ETFs as well, you'll be in the driver's seat. Rest assured that you will have a great performance, great dividends well into the future as a long-term investor. As always, check out the link in the description of this video to download Blossom, a free investing app. On Blossom, you can see my entire ETF portfolio. Whenever I buy ETFs, my investing journey, you can give me a follow on Blossom and I will give you a free follow back. Ask me any questions there on Blossom about ETFs. I'd love to see you there. I will see you on Blossom. Now, if you guys like this video, please give it a like because this cute puppy did. If you want to see every single ETF that I invest in, check out this video right here for completely free. I love you guys so much. Continue crushing the stock market and take it easy. Peace.